Jain, President and Group CFO at IIFL Finance, now joining in on the show to talk a little bit more in perspective as to what the implications are of the RBI circular that has come down and the crackdown of RBI on some of the financials. Thanks so much for taking time out. Give us a sense as to what exactly you've made of the latest note coming in.
So you mean the one that came yesterday?
With respect to the RBI crackdown on some of the banks and NBFCs?
No, I'm sorry, you mean the one that came yesterday on the
Yes,
AIF?
that's right, yes.
No, principally it's a good move. So RBI wants to make sure that people are not at the guard of hiding their NPAs, doing some actions which may not be very healthy for both the balance sheet and for the market and might disguise people. So that way, I think it's a very positive, pragmatic move. And everybody will become more disciplined around making sure that they are keeping their assets in good check and not using these avenues to just camouflage things on the book.
Will something change for you? Have you
No, not really.
Nothing. Okay.
No, not really.
Will a lot change for you after Reserve Bank of India's new policy guideline on checking weighted average for unsecured loan?
No, it won't either. But that came on November 16th. That's primarily talking about...
That's why I'm asking you this.
So that primarily talking about consumer loans, retail consumer loans, unsecured and secured. So we barely have around 2-3% of the entire book, which is lending towards this segment. So even if a 25% risk weight goes up, we did give a release in an analyst meet recently where we talked about that it just marginally could impact 20-30 basis point on our overall capital adequacy.
Right. But Kapish, help us understand. Yeah. Sure. But help us understand, this new RBI circular which has come on transactions pertaining to AIFs, alternate investment funds, that is. How exactly will the entire mechanism work? Because, there are a lot of caveats there that, REs can't really liquidate on time. They need to make 100% provision. If invested already, they need to liquidate the investment within 30 days as well. Does it just make the whole process a little cumbersome?
See, so if you have, let's take an example. If you have debtors who are a little under stress, and then if they can move into higher buckets with regard to delinquencies and NPAs, and just to prevent that to happen in your portfolio and visibly making it appear on your balance sheet, people have, so there is a practice of just moving some of these assets into an AIF structure, and then they are now in an investment portfolio which gets marked to market. But there's no potential requirement for a higher provisioning under the regulations of RBI and otherwise, under the ECL model as well. And the objective is to make sure that one is not doing this for that particular intention, but is doing independently for an investment opportunity. So if any of your debtors who are under stress, and if you're moving into an AIF, either now you would need to offload them within 30 days, liquidate it entirely, or you make 100% provision. And the mandate is that those debtors who were in your book in the previous 12 months before you move into an AIF structure. So that's something which is not a very healthy practice, and that should now go away and make sure that people are more governed in their practices and making it more transparent when they are reporting such numbers.
Okay. In general, do you think the base effect in growth is now kicking in? Because banks are telling us that the credit cycle is growing, but the base effect has started. Some of your peer NBFCs are also saying the same thing, that, okay, we will grow, but the rate will be slowing down because of the base effect. What is your assessment?
You need to look into product by product. Yeah, we operate in 5 different products. We have gold, we have housing, we have microfinance. These are the primary ones. They aggregate close to around 70% of our entire book. In a gold loan business, the key is gold prices. While India is still like 65% unorganized market, so growth opportunity is humongous. As long as you're building the loyalty factor with your customers and you are present in the markets where the customers are looking for borrowing, you can grow subject to gold pricing holding fine for you, because the loan value is very important. These things have worked out well. Gold has stood well, and gold is only firmly standing. With that support and with the expansion that we have done, I see the gold business should grow at a good pace going forward as well. There's a lot of my branches, close to around 1/3 of the 2,700 branches that we hold, still needs to be fully penetrated. They opened in the last 12 to 18 months. With that kind of mobilization of business that we can do through the distribution, we think that gold business should grow and hold stable. Similarly, when I go to housing of course have seen a lot of rate increase, close to around 250 basis point on repo is not an easy thing, because ultimately it gets passed on to the person who's serving those loans. But on the other side, in those markets, property prices in comparison to the affordability of people have really not made a huge dent. So on a balance effect, there's still huge opportunity for the housing business to grow. And in our case also, we added close to around 200 branches from 125 in March 21 to close to around 380 today. That gives enough penetration availability from a distribution perspective to mobilize market. So there again, the opportunity is just standing fine. We need to also see how the interest rate market pans out going forward, because that can become a deterrent. We need to make sure that we are not taking too much of exposure on the borrowers who are seeing a challenge on their ability to service these loans, and that those elements needs to be put into check to make sure that you don't have asset quality risk. As long as those elements are taken care of well, there's still a good opportunity for growth in a market like India across products. So these are two primary ones. Microfinance, you have to talk about. Microfinance, of course, has gone through a huge growth over the last couple of years, more particularly in the last 15 months. So there could be a base effect there. Things need to get normalized. And therefore, that market can relatively slow down a little. But in comparison to the guidance that the company has given on an overall basis for a 25% CAGR, I believe the microfinance will still be on a higher delta from a growth perspective for the next year or two, at least. And then it might just get normalized to a 25-30% growth.
No, thanks so much for giving us perspective as to what exactly this news means for the sector and for the company as a whole. Time to shift